Welcome to the deep dive. We love getting into these complex reports, really stripping away the jargon.
Yeah, finding those nuggets you miss in a quick read.
Exactly. And today, we're tackling UPL Limited's Q1 FY26 results. That's for the quarter ending June 30th, 2025.
Right.
Our mission, as always, is to cut through the noise, look at the raw data from their earnings call, their presentations, and really pinpoint the key takeaways, maybe even some surprises.
It's not just numbers, is it? It's the story behind them, especially in agriculture right now.
Absolutely. And these insights, they're straight from UPL's official Q1 FY26 materials, the call, the financials.
Good stuff.
Now, Q1 often sets the tone for the year, and for UPL, well, they navigated some pretty significant global economic currents this time.
Oh, definitely wasn't smooth sailing.
The real story here, I think, is how they managed to not just, tread water, but actually gain some ground.
It's fascinating, yeah. The number of macro challenges they were facing head on this quarter, it was quite the gauntlet.
Okay, let's unpack that then. What were those big headwinds UPL was staring down at start of Q1?
Well, first off, Latin America, especially Brazil. You had lower commodity prices hitting things like soy and corn hard.
Right.
That translates directly into farmer income stress. Plus, higher interest rates, volatile currency, it all put pressure on their distributors.
Okay, so Brazil was tough. What else globally?
Beyond that, you still have those geopolitical uncertainties simmering. New concerns around U.S. tariffs popped up again, influencing market sentiment, trade flows. And you can't ignore China.
Ah, yes, China. The oversupply issue, particularly in active ingredients.
Exactly. That's been ongoing, and it continued to put significant pricing pressure on AIs, making the whole business climate tougher.
So pricing pressure from China.
Yeah, and then layer on top, mixed weather conditions across different regions, always a factor in ag.
Always.
And just the general background noise of higher interest rates globally makes capital more expensive for everyone.
Wow, okay, so that's quite a list of challenges. A cocktail, as you said.
It really was.
So, despite all that, a big question. Did UPL sink or swim in Q1? What do the headline numbers actually tell us?
Well, the numbers, they paint a picture of, I'd say, remarkable resilience, more like swimming strongly against that current.
All right.
They reported revenue of 9,216 crore. Now, that's a 2% increase year on year.
Only 2%, but given the headwinds.
Precisely. And if you dig into how they got that 2%, it was 1% from better pricing, plus a helpful 2% boost from currency exchange rates.
Oh.
That did get offset slightly by a 1% dip in volume, but still, achieving any growth in this environment, that's noteworthy.
That really is something. What was the key factor, would you say, that let them find that growth in such a tough quarter?
I think connecting it back, it really boils down to a couple of things. One, an improved product mix, focusing on stuff with better margin.
Right.
And two, really disciplined cost management, especially in their crop protection business. And that combination, it drove their contribution. Think of it like gross profit up significantly. It hit 4,001 crore. That's a 12% jump year on year.
12% jump in contribution. That's huge.
It is. And the margin itself was over 43%. That's an improvement of about 390 basis points, nearly 4 full percentage points. Massive, like you said.
Wow. So lower input costs, better mix. That really turbocharged the margins then. How did that flow down to profitability, EBITDA, net profit?
Yeah, that strong contribution definitely flowed through. EBITDA showed really solid double-digit growth. It was up 14% year on year, reaching 1,303 crore.
Okay.
And the EBITDA margin, over 14%, that's up 150 basis points. Again, driven by that better contribution margin.
And bottom line, profit after tax. I know they've had losses previously.
Right, so profit after tax, or PTMI, it was still technically a loss, but it narrowed dramatically. Came in at 88 crore loss. Compared to a loss of 384 crore last year this quarter. So that's an improvement of around 300 crore.
Okay, that's a big swing.
It's a clear sign their operational improvements are really hitting the bottom line now.
That definitely points to, serious financial discipline. Let's talk about the balance sheet. That's been a huge focus area for them, hasn't it?
Absolutely. And this is where their strategic moves really, really show. Net working capital, they slashed it by a massive 3,300 crore compared to last year.
Okay.
Brought it down to 11,025 crore. But maybe even more impressive is the net working capital days metric.
Right. How quickly they turn over capital.
Exactly. It went from, frankly, a sluggish 121 days down to a much leaner 86 days.
Wow. 86 days. That's a 35-day drop.
35 days. That's not just some accounting tweak. It means they're running a much tighter ship. Less cash tied up in inventory and receivables. It frees up a lot of capital.
A huge difference. And debt. That's always the big one investors look at.
Key metric for sure. And net debt was cut by over 6,129 crore. That's about $806 million year on year.
Okay.
So as of June 2025, it stood at 21,371 crore, or just under $2.5 billion.
And how does that impact their gearing ratios?
Dramatically. This is where you see the health improve. Net debt to EBITDA, it dropped from 5.4 times last year.
Which was quite high.
It was down to a much healthier 2.6 times.
Big improvement.
And net debt to equity improved too, from 0.9 times down to 0.6 times. Basically, they're far less leveraged now, much stronger balance sheet to face any future shocks.
That shift really is significant. Were there any specific liquidity events or maybe external signs of confidence that underline this turnaround?
Yeah, several actually, and they all kind of reinforce the story of financial resilience. For one, they prepaid a $250 million long-term loan. It wasn't even due until September 2025.
Made it early.
Yeah, using strong cash flow they generated back in Q4 of the last financial year.
Okay.
They also redeemed $400 million worth of perpetual bonds back in May.
Right.
And then there's the rights issue. The committee approved the second and final call. That's 180 per share for the partly paid ones.
Yeah.
That should bring in about 1,688 crore, or $200 million.
When do they expect that cash?
Proceeds are expected by the end of September 2025, so fairly soon.
And what about the rating agencies? They're usually a good barometer of external confidence. Any movement there?
Big news there, actually.
Oh.
Both Fitch and S&P upgraded their outlook on UPL from negative to stable.
Ah, stable. That's key.
It is. UPL themselves called it a strong endorsement of their financial resilience. And it's not just, a pat on the back. It genuinely helps with borrowing costs, investor trust.
Yeah.
It matters.
Definitely. Okay, so we've got the big picture. Navigating headwinds, boosting margins, strengthening the balance sheet. How did all this play out in their different business units? So let's start with the big one, UPL Corp Global Crop Protection.
Right, UPL Corp. So their revenue actually dipped slightly, down 3% year on year.
Okay, why was that?
That was mostly down to those seasonality issues we talked about in Brazil. It mainly hit their insecticide volumes there.
Mm-hmm.
But here's the fascinating part again. Despite revenue being down 3%, their contribution was up 13%.
Wow.
And EBITDA grew by 23%.
So making more profit on less revenue.
Exactly. It really highlights, strong operational resilience. Their productivity initiatives are clearly working, doing more with less, essentially.
So where were the bright spots geographically for UPL Corp, and where were things tougher?
Growth was actually really strong in India, up 21%. North America and Europe also chipped in nicely, both up 8%.
Okay.
They mentioned specific product successes there, herbicides, biofungicides doing well.
And the challenges? Still LATAM?
Yeah, the main drags were Latin America, especially Brazil, still feeling that pressure, and also the rest of world category. That's Africa, Australia, SE Asia. Both those regions were down about 10%.
Why there?
Mostly insecticide pricing pressure still, and some broader challenges across seeds and crop protection in those markets.
Got it. And how did they manage costs so well to get that margin lift despite lower revenue?
Lower input costs were a big factor, plus running their plants at higher capacity utilization rates.
Okay.
That combo led to a significant improvement in their cost of goods sold COGS, about a $58 million benefit in the quarter.
$58 million. How did that break down?
They said about $30 million of that came from lower inventory costs and another $20 million from running the plants more efficiently, the higher utilization.
Then they expect that benefit to stick around.
Yeah, they anticipate this helping them through the rest of the year. That's a nice tailwind to have.
Definitely. Now, I remember hearing something about a distributor issue in Brazil, of restructuring. Did that impact the numbers?
Yes, good catch. There was a $13 million non-cash ECL accrual. ECL is expected credit loss.
Right.
It was basically an accounting adjustment tied to restructuring a payment plan with one specific distributor in Brazil.
So one-off.
Management presented it that way. They said it's expected to unwind as they recover the payments over time, and importantly, they don't see similar issues with other customers. So hopefully contained.
Okay. Looking ahead for UPL Corp then, how's the order book looking? And what's the vibe on pricing for global crop protection?
The order book is actually looking stronger than last year at this point, particularly in Brazil, interestingly.
Ooh, why is that?
Driven by negotiations for the upcoming season, apparently. And they also mentioned sort of purposefully phasing some business into Q2 to help manage working capital better.
Strategic timing. Makes sense. And pricing. Any relief there?
Somewhat. They see some, quote, green shoots for specific molecules coming out of China, things like clethodim, mancozeb, prices stabilizing or maybe ticking up slightly.
Okay, some positive signs.
Some, but overall for Q2 through Q4 for UPL Corp, they expect growth to come almost entirely from volume. They think blended average pricing will likely stay pretty flat.
Got it. Volume's up, prices flat. Now, what about those new U.S. tariffs? The 25% on Indian exports, that sounds like it could hurt.
You'd think so, right? It's a significant tariff, but UPL seems relatively unconcerned.
Why is that?
Their reasoning is basically twofold. One, they still have a comparative advantage. The tariff is 25% for India, but it's roughly 55% for products coming from China, their main competitor.
Ah, okay. So they're still better positioned than the alternative.
Exactly. And two, they say less than 10% of their North American turnover actually comes from products made in India and exported. So the direct exposure is limited.
Okay, that makes sense. Let's switch gears to UPLSS. That's their India crop protection business. That looked like a real bright spot this quarter.
Oh, absolutely. UPLSS was a shining star, really strong performance. Revenue was up a robust 13% year on year.
13%. And was that price or volume driven?
Both, actually. Strong volume growth, up 9%, and also improved pricing, up 4%.
Nice combination.
And the margins there, huge improvement. Contribution margin jumped 450 basis points to nearly 33%. And EBITDA margin was up 540 basis points to over 22%.
Wow, really impressive numbers domestically.
Truly.
What drove that? And does it change their strategic position in India at all?
Well, they benefited from a favorable season, first off, good performance in herbicides, and they had some successful new product launches, mentioned things like Centurion Easy and Kenora Easy. Strategically, this is interesting, there was recent news about a major competitor potentially exiting the Indian market.
Oh.
Yeah. And UPL explicitly said they're actively looking at that, evaluating it as a potential opportunity. Fits right in with their growth plans. Could be a real chance to grab market share.
Definitely something to watch. Okay, moving on to Advanta, their seeds business. Did they match that kind of growth? Any surprises there?
Advanta also delivered strong double-digit revenue growth, up 20% year on year.
20%, even better than SAS.
On the top line, yes. Fueled by 12% volume growth and a 7% price increase.
Where did that growth come from?
Key drivers were corn, both in India and Thailand. Also, grain sorghum and sunflower down in Argentina.
Okay, strong top line. But were there margin pressures, maybe?
Ah, you hit it. Despite that strong revenue growth, they did face margin pressure in Advanta.
That's interesting. Strong sales, but shrinking margins. What happened there?
Exactly. It's a bit of a paradox. Their contribution margin actually contracted by 237 basis points, and the EBITDA margin shrank by 330 basis points.
Like a squeeze.
A few things mentioned. Lower canola volumes in Australia hurt. Lower recovery rates in Thailand, basically getting less usable seed from the raw crop.
Okay.
And also increased costs back in India. Things like buying raw seed, lower recovery from raw corn processing due to rain, apparently, and just higher overheads from some new hiring.
So a combination of factors hitting profitability despite selling more.
Pretty much. Sold more, but the cost per unit effectively was higher in some key areas.
Right. Now, there was also some chatter, I think they called it, about UPL maybe looking to buy new seeds from New Farm. Any substance to that?
Yeah, that rumor was definitely doing the rounds. And look, New Seeds is an interesting asset, geographically diverse portfolio.
But
UPL basically poured cold water on it for now. They confirmed there's significant ongoing litigation between UPL and New Farm.
legal issues.
Yep, there's actually trial scheduled for next year in Australia, so that legal battle effectively blocks them from even exploring an acquisition right now.
Okay, so that's off the table for the foreseeable future then.
Seems like it.
All right, last business segment. Superform. That's their specialty chemicals arm. How did that niche area perform?
Superform had robust growth too, revenue up 9% year on year. That was led mostly by strong growth, 21% in their super specialty chemicals, or SSC, segment within that.
Okay. And is that mostly agricultural chemicals?
Actually, no. They pointed out that non-ag chem revenue makes up about a quarter of Superform's total business, so there's some helpful diversification there.
Interesting. Margins.
Contribution margin improved slightly, up 50 basis points to just under 25%, but the EBITDA margin dipped a tiny bit, down 20 basis points to 13%, mainly due to higher SG&A selling general admin costs.
Got it. Okay, so beyond the numbers, the profit and loss, UPL always emphasizes sustainability, ESG.
Yeah.
It seems core to their strategy. What did they achieve there in FY25? How does it connect back to the business?
Yeah, they really lean into this, and they've made some, frankly, significant strides. For their FY25 goals, they actually hit several targets ahead of schedule.
Oh, really? Like what?
Things like reducing water consumption intensity by 49% from their FY20 baseline, CO2 intensity down 38%, waste generation intensity down 52%.
Those are big reductions, nearly halved water use intensity.
Huge numbers. Plus, they hit 38% of revenues coming from sustainable products and 60% sustainable sourcing.
And how does hitting those ESG targets actually help the business? It's not just PR.
Well, they'd argue strongly it's not just PR. It demonstrates real operational efficiency. Using fewer resources costs less. It optimizes things. And increasingly, it aligns them with market demand, customers, investors. They want sustainable solutions. It builds long-term value.
Hitting those kinds of reductions, especially water and CO2 for a company this size, that must have taken serious effort. What was the key to achieving that so quickly?
It sounds like it was a pretty multi-pronged approach, but a key factor they mentioned was embedding sustainability into operational KPIs everywhere. It wasn't just a separate department's job.
Making it everyone's responsibility.
Exactly. Plus investments in things like process optimization, water recycling tech, renewable energy at their manufacturing sites.
Okay.
They also mentioned the community side, improving 1.75 million lives through various social projects. That builds, social license to operate.
Right. And looking ahead, what are their goals for, say, FY30?
They've set even more ambitious targets for FY30. They're aiming for a 60% reduction now in water, CO2, and waste intensity.
60%. Wow.
Yeah. And 55% of revenues from sustainable products, 70% sustainable sourcing, and reaching 3 million lives through community work.
Ambitious goals.
Definitely. And they couple this with talk of exemplary governance, a strong board, passionate leadership. They highlighted external recognition, too, being in the DJSI World Index 2 years running, recertified for FTSE4Good.
And employee engagement, sometimes overlooked.
Good point. They mentioned a high score there, 89, apparently top quartile, which suggests, a motivated, productive workforce behind all this. Internal health looks good.
Okay, so pulling it all together, what does this mean as UPL looks forward? What's the outlook? The strategic vision for the rest of FY26 and beyond?
They're saying they remain cautiously optimistic for Q2 and the rest of the year. They expect the full year to be margin accretive.
And they stuck to their guidance.
Yes, they reaffirmed the FY26 guidance. 4-8% revenue growth and 10-14% EBITDA growth year on year.
Okay.
Management sounded pretty confident about delivering that. They're banking on continued operational excellence and maybe a helpful monsoon season.
And longer term. Strategy for value creation, more debt reduction. What's the big play?
The message there was crystal clear. They're focused on, quote, unlocking value across all platforms.
Wow.
Through restructuring, potentially bringing in strategic investments, maybe other liquidity events. They actually said they'll be engaging advisors soon to help with this.
Okay, so potential structural changes coming.
Sounds like it. With a very clear goal. Significantly deleveraging the balance sheet over the next 1 to 2 years. So it's not just about paying down debt incrementally. It sounds like potentially bigger moves to optimize the whole portfolio and drive shareholder value.
Right.
And they'll keep driving growth through new products, smart organic investments, and they see good prospects for that super specialty chemical segment too. So a few different levers they plan to pull.
Okay, so let's try to wrap this up. UPL's Q1 FY26. Really shows remarkable resilience, doesn't it? In what's clearly a challenging global ag environment.
Definitely resilient.
They've shown really strategic financial management, getting that balance sheet in much better shape, and they've laid out a clear path towards, well, sustainable value creation, moving from strength to strength, it seems.
Yeah, navigating the volatility while keeping that long-term vision, not just surviving, but, finding ways to thrive.
And for you listening, understanding these kinds of moves, the margin pressures, the strategic shifts, the debt reduction, it can really help you better interpret market signals, assess the health of these crucial global industries that touch everything from, well, the food on your plate to countless products you use.
Absolutely. It connects to so much.
So here's a final thought to leave you with. As UPL keeps refining its portfolio, pursuing this strategic value unlocking, what could be the broader implications? How might other big agricultural companies balance that need for global growth with these really localized challenges we saw in Brazil or Australia? And maybe just as importantly, how does that deep commitment to sustainability potentially influence their long-term resilience, especially in a climate that's constantly changing?